Okay, welcome to this video today where we're talking about the latest news around the UK autumn budget that was recently announced by Rachel Reeves, the Chancellor of the Exchequer. So why am I doing this video today? So I'm a financial wellness expert and also a tax accountant, and I love breaking down information for you so you can understand how it impacts you and what it means for your pocket. So there have been many announcements that are cutting across different topics, primarily tax adjustments and updates and certain things to do with electric vehicles and pensions and all sorts of things. We're not going to cover every single thing, but we're going to talk through most of them. And hopefully you will be able to build more confidence in your financial planning and also how you earn, save, and invest your money. Okay, so let's get straight into it, right? So the first thing to be aware of is that there's been a freezing of the income tax rates. Okay, that's for income tax as well as national insurance in the UK. So perhaps that sounds like good news because then it means there's no increase to the tax rates for you, as one would think. Okay, let's just look into that a little bit more. So right now, your income tax is charged at 0% when you earn less than 12,570, or for any of your income that falls into that bracket. And then anything above that, up to £50,000, you pay tax at 20%. And then anything above 50,000 up to 125,000, you pay tax at 45%. I'm literally just going to show you what this looks like so that it's nice and easy and we're all flowing on the same page. So this is the gov.uk page that's got those rates. Okay, so what they're saying essentially is that all this has been frozen. No increases, no adjustments, it's staying the same. So this personal allowance that's at 12,570 has been at this rate since April 2021, and prior to that it was at 12,500. Okay, so the last increase in your personal allowance would have been just £70. And what's happening now is they're keeping it at this rate of 12,570 until April 2031. Okay, so let that sink in. Same applies to these rates, the 20% up to what you earn up to £50,000. That's the basic rate, and then also 40% for what you earn between 50,000 and 125,000. Anything above 125,000 is 45%. So I just needed to show you this illustration just so we can understand what this means for us. So like I said, it sounds like good news, doesn't it? It sounds like it's great stuff that there's no increase to the taxes, but what's actually happening is you are indirectly paying a hidden tax, or what's called a stealth tax, right? And what this means is as your income increases, and this income increase I'm talking about for now is purely the inflation adjusted one. This is not you getting a big promotion, or this is not you changing roles to start earning more money. I'm not even touching that as yet. I'm just talking about you perhaps staying in the same type of job, but your income increasing for inflation purposes only. So inflation adjustments are normally around about 2% a year. So if we are to use an example, how the stealth tax will work and what the fiscal drag will look like. I know I'm throwing a lot of big words, but we'll break that down. I'll show you an illustration and then it can make more sense. So what it essentially means is that as your income perhaps increases in line with inflation for starters, you are being paid more money, but because the tax rates are staying frozen, right? You are actually paying more tax without realizing it. Because why? If you were someone who was just earning less than 12,570 and paying no tax, and all of a sudden you're earning 13 and a half or 14,000, right? Now you are falling into the basic rate, but there's no adjustment to your actual quality of living or your actual net pay in terms of what it can do. So I'm sure you would agree with me that what you could spend £1,000 with 2 years ago is different to what you can spend £1,000 with today, because inflation means that the cost of those goods and services has just naturally gone up as an increase, right? While your actual money itself is not actually going up in value. Okay. And so with this fiscal drag and this stealth tax, what the government has done is they've frozen these rates But what you are left with to spend is not as powerful as it was before. So I've got this example thanks to courtesy of the Financial Times, where you've actually got what's called a fiscal drag calculator. You can go and look at this in your own time if you wish. So what I've done is I've put a 35K salary there just to put a tester to the calculator to show you what happens. So when someone is paid 35K, their effective, their actual tax share that they pay is actually 17.9%, because remember, they're only paying tax on income above 12,000. Okay. So they're not really paying 20% on their full 35,000, but they're paying a partial amount which gets adjusted to 17.9% effectively. So in the current year, they're earning 35,000, and the income tax they're paying is worth 17.9%. Great. There's no extra tax there. But as the years go by, their salary is increasing. Then remember, this increment I talked about is just adjusted for inflation, right? So it then means that by the time we get to 2031, which is the year that this is frozen until, their 35K salary in real terms of inflation adjusted income will now be worth 38,000. They're not essentially really making more money, because what this 38,000 could do in 5 years' time is probably the same as what it does today at 35,000. Okay. But it means that the government has earned much more in tax from this person each year that increment has happened. They've earned an extra 77 pounds in the first year, an extra 149 in the next year, and so forth, until the total cumulative extra tax paid to the government is actually 1,132. So I appreciate this is intricate detail, but I just wanted to demonstrate to you what stealth tax means in terms of the fiscal drag that happens. If we were to change this income to, let's just say, £50,000 a year, you then see a slight difference in how this impact of the fiscal drag happens. So the tax share will actually now be 21%, because remember, we've got a portion of income between 12 and a half and that 50,000 that's only being taxed at 20. So you've got the 20% and an odd 1% with that. But every year when this person gets a bit of a pay rise that's adjusted for inflation, by the time we get to 2031, that 50K is now worth about 55K. But they've paid an extra £3,195 in tax, which they've not felt because the tax rates have felt the same. So the government is saying that they're freezing these tax rates and actually raising £8 billion over the next 5 years through this method, where people do not feel like they're actually paying tax, but they're indirectly paying more tax because the money they're left with is not doing much. If the government was really helping people to save on taxes, they probably would be extending or increasing this personal allowance to beyond just 12,500, to probably be 13,500 or 14,000 or 15,000. Then that way people can actually feel that they're left with more money in their pockets. Okay, so it's great to celebrate that, there is this freezing of the tax rates, but just be very aware that this stealth tax or this fiscal drag that's happening in the background doesn't necessarily leave you better off because those tax rates have been frozen. So I hope that makes sense. I could always do a separate video and get into this in more detail, but we've got so much more to cover. Let me do this very quickly. The other change that you're going to see that's been announced is to do with the national minimum wage. That's increasing. So it's being increased by 50p per hour. So national minimum wage has been £12.21 for adults, and it's now going up to £12.71, which for someone who works a full-time job may translate to an increase of about £900 extra money once this kicks in. And what I'm covering to do with the national minimum wage and this income tax freeze, these are things that are being implemented immediately from April 2026. Okay, so we'll probably do it in a bit of a chronological order so that you know what's impacting you more now than what's coming into impact, or into effect rather, in 2 or 3 years' time. So the national minimum wage that's going up is an extra 50p for you. Okay, that's great. Good news for the employees that are on minimum wage. But I guess if you're an employer and you have, some employees and people that you pay, this means an increase to your wage bill. Okay, so I do have clients that are business owners and they look closely at their costs on an ongoing basis when we do our cash forecasting and calculating of taxes and things like that. So this is going to have an impact. Perhaps it might mean that some employers will not take on as many staff as they wanted to, or it just means that, you know, the bill for this extra national minimum wage rise is passed to the end user or the consumer, which is you and I, in most cases. And then the third change that's coming into effect from April 2026 that's going to impact taxes for some people is that there's going to be a 2% increase on dividend tax. Okay, so more tax on dividend income. This simply means that if you have investment income that is not in a stocks and shares ISA, then you pay an additional level of tax of an extra 2%. So if you're a basic rate taxpayer and you've got investment income in the form of dividends, then that's going up to 10.75%. If you're a higher rate taxpayer, that's going up to 35.75%, right? In most cases, however, the people that are impacted by the dividends that are outside of ISAs will be people that own their own companies. So directors, company owners, or people that have got investments in companies, like I said, that are outside of the stocks and shares ISAs that protect them from tax. So most people that own a business, perhaps they pay themselves a salary, and then they also pay themselves in dividends. So that increase is coming in from April 2026, where they're experiencing or they will they will feel a slight pinch in how much they take home because the dividend tax has been increased. There will be other changes from April, such as things like rail fares that are being frozen. So if you travel by train, you will know that every year in April the fares go up for the trains, right? Whether you've got a season ticket, if you're buying return tickets and all that kind of stuff, it's a thing, right? So thankfully from April 2026, that's all being frozen on regulated fares. Some fares are unregulated because they're probably first class tickets or they are advanced tickets, etc. That's down to the train companies to increase the prices on that. Things like prescriptions from April 2026, again, that's not going up. If you are given a prescription by the doctor and you are getting medication from the pharmacy, the amount you're paying is being frozen at £9.90. So that's good news. Then we're going to move on to the following tax year, which is April 2027. What is changing from that point? The key things that are changing from that point are that there's going to be more tax to pay on savings interest. So if you have savings in a savings account that's not in a cash ISA, then you actually pay tax for any interest that you earn on that saving if the interest is above the basic personal savings allowance. Okay, so the personal savings allowance is the tax-free element of your interest income. Now, let's be realistic how these numbers would be. So there is a personal savings allowance of £1,000, which means you do not pay any tax on interest above £1,000, sorry, below £1,000. And for you to actually earn interest of £1,000 as a basic rate taxpayer, right, it means that your savings are above £22,000 roughly. Okay, so if we do the math and assume that the interest rate on these accounts is about 4% thereabouts, or 4.5 to 5% if you're lucky, right? You would need to have a significant saving of more than £20,000 to actually exceed interest of £1,000. Okay, so let's put context into all this. If you're a higher rate taxpayer, then you'd only actually pay tax on your interest if your interest is above £500. Okay, and that means that that tax kicks in if your savings are more than £10,000 or £11,000 thereabouts. Okay, so you would worry more about paying tax on interest depending on your tax bracket and depending on the level of savings we're talking about. Okay, so the government are just saying, look, the more you've got saved, the more we want to tax you. We're adding an extra 2% to how much tax you already pay on that. The same applies to property income. They are increasing the tax on property income, which means that if you are a private landlord, so you've probably got additional investment properties in addition to your own property, Bearing in mind they reintroduced the stamp duty land tax when you buy the properties now. So, okay. So if you're a private landlord and you have a buy-to-let, for example, or multiple properties that you own, and these properties are not structured within a limited company, then you are going to be impacted by this extra 2% in property income. Okay. So go back to your accountant, look at how you can structure your property portfolio if you are impacted by this. The other thing that's happening from April 2027 is also the adjustments to the cash ISA limit. Now, we've got different types of ISAs in the UK, the individual savings account. Some people have cash ISAs. Some people have stocks and shares ISAs. Okay. Now, there is a bit of confusion around how this is going to work. The key point is that the maximum allowance you are allowed to save into these ISAs is up to 20,000 altogether. But the change is that the government is saying they will only allow a maximum of £12,000 in the ISA for the cash ISA, which is essentially just kind of like a cash savings account, right? Where you probably have a high interest rate if you've got that. But the difference is if you're below the age of 65, they are essentially trying to direct people to invest more money. Okay, I'll do a separate video on this. It's to do with the culture in the UK. Not a lot of people are actually investing. Okay, and the government is trying to change the culture and also invest more into the stock market, boost the economy, support businesses, all that kind of stuff helps to boost the economy when people get into investing more than they are at the moment. Okay, so that's April 2026, April 2027 covered for you in terms of changes coming. The other things happening from April 2028, so this is now a couple of years down the line, but it just helps you plan ahead, is to do with electric vehicles. Now, this was a little bit of a pinch, to be honest, because if you owned an electric vehicle, the original incentive was that it was going to be tax efficient for you. So a lot of people benefited from, not actually having to pay tax on owning an electric vehicle. But that's changing from April 2028, where there's going to be an introduction of owners having to pay as a tax per mile of 3p for battery owned vehicles. If it's hybrid, it's just one and a half pence. But essentially, it's saying that the more you travel, the more tax you're gonna pay. So if it's 3p per mile and you've traveled 10,000 miles a year, then your tax bill for your electric car is about £300 a year. Let's just look at it in that context, right? Just so it makes more sense. And then the other thing that's also changing from April 2028 is the fact that if you own a property, there is something called mansion tax that's coming through for those that are ultra rich and own properties that are worth more than £2 million. They will be paying £2,500 as a tax. That's an enhanced higher rate kind of council tax. So I don't think that's a big problem for people that are wealthy. £2,500, is probably not a lot of money for them, but the rates that they pay increases depending on the value of the property, but that's the baseline that it starts from. Other changes that we're also going to see that have been mentioned is to do with things like salary sacrifice. So salary sacrifice is a pension uh, um, deduction, a type of pension deduction that happens where you elect for a salary sacrifice type rather than just the standard pension deduction. Again, I'll do a separate video on this because there's a bit of confusion about understanding whether everybody's in salary sacrifice or not. Not everybody's in salary sacrifice. It essentially means that your employer deducts your pension first before any tax is applied. So what the government is saying that when that deduction is done, the maximum that you can get without any national insurance being paid is £2,000. So anything you pay into the salary sacrifice style pension, and it's more than £2,000, you actually pay national insurance on it. For standard pensions, where you've got auto enrollment and you pay 5% and you get the tax relief, etc., that's already got national insurance included in it. You are actually already paying it if you're not aware. And the truth is that only about 30% of people in the private sector are actually using salary sacrifice pension payments. And those in public sector, it's probably about 10%. So it's not a huge amount of people, but it's going to be very important to sort of understand what this actually means for you. It may not be any change at all, but it's really just being aware that that's kicking in. Lifetime ISAs, apparently there's going to be the current lifetime ISA is being scrapped and there's going to be a new saving scheme. We'll wait to hear what that looks like. That's for people that are trying to get onto the property ladder. I hope it's something better, something easy, but I currently like the ISAs as they are, so I'm a little bit disappointed that that's happening. But overall, I think it is quite clear that some of the changes that are happening, like I said, some of them are happening immediately from next April, others are being phased in over time. So it's going to take a while for some of the effects to be felt. But I think the key thing to take away today that I'm really trying to bring to you is that be very clear on what impacts you as an employee. And what impacts you as a business person, okay? Because the impacts that this brings for different people in different groups can be slightly, slightly different, right? And so just be very clear on what you need to change if you need to do anything differently. Ultimately, at the end of the day, I think the key thing is we all want to be able to earn more money. We all want to be able to be tax efficient in how we're earning that money. So if you're running a business, just be clear on how this is going to look like for you with the changes in the dividend allowances and the dividend tax rates that are kicking in at 10.75% and 35.75%. And if you're an employee and you are earning the minimum wage, hip hip hooray, you're getting an extra 50p an hour. But there's so many other things that we can discuss, and I'll be posting more videos that tackle these issues more individually, just so that we can be up to date and make sure that we are being tax efficient and we are being financially aware of our purchasing decisions. So hopefully this is helpful, and I look forward to you tuning in to the next segment. Have a lovely day and keep winning. Thank you.